Good morning, everyone. I'm Susan Lund, Vice President for Economics and Private Sector Development here at the IFC. And welcome to all of you who joined in person and online for today's event, in which we are launching a new book that was jointly produced by the World Bank and IFC, Financing Firm Growth, the Role of Capital Markets in Low and Middle Income Countries. I first want to say that we're very grateful to the government of Luxembourg for their support of this research that went into this book. The private sector plays a very critical role in driving economic development, job creation, and innovation. And we all know that one of the main constraints that hold back firms is lack of access to long-term financing. Developing local bond and equity markets is a critical step if we want to fill that gap. So this new study looks at the development of debt and equity capital markets over the last 30 years in emerging and developing countries around the world. It draws on a unique database of 80,000 firms from those countries and comes to conclusions that document the growth of capital markets issuance and the link to increased productivity at the firm and the national level, and that capital markets support development objectives, including growth and job creation. So for today's discussion, we're going to start by opening remarks from IFC's Managing Director, Mr. Mokhtar Diop. We're then going to have a short presentation of the main report findings by two of its principal authors, Cesar May from the IFC and Manuel Carlos Santana from the World Bank. After that, I will have the pleasure of moderating a panel of distinguished academics and experts on capital market development to discuss some of the implications of the research and where we stand today and recommendations for policymakers, private sector, and investors. So without further ado, let me introduce Mokhtar Diop, Executive Vice President and Managing Director of the IFC, and welcome him to the stage. Mokhtar has had a long career that touches on private sector development and capital markets in particular, including being Vice President for Africa at the World Bank, Vice President for Infrastructure, being Minister for Finance for Senegal, and starting his career in banking and then at IMF. Throughout his career, Mokhtar has been a tireless advocate for private sector-led development, and he's also been an advocate in each of his positions for developing strong analytical economic research. Mokhtar is an economist by training, and let me tell you, he is still an economist despite his many other duties. This commitment to developing research is one of the reasons we are launching this book today. So without saying anything else, let me welcome Mokhtar to the stage.
Good morning, everybody, and thank you very much for things. I think that Susan has been far too kind by describing me as someone who thinks is interested in economics, but I'm not sure that I'm still an economist, because when you meet some kids who come from college and they start talking, you told them that, when you were young, you were doing time series at econometrics, and they tell you, do you know the last test on fractional co-integration, and you say, it's a long time, I haven't looked at these kind of things. You start saying that you are rusty a little bit. So some of the remains are still here, so we keep it, but to be on a serious note, I think that it's important that we do what we are doing to be able to shed light. I'm with my colleagues and friends from DEC, and I would like to really thank my friend in the meeting, who is my partner in crime in this effort. In the meet, and I was leading the chief economist of the bank. We've been working together in many occasions. And throughout our career, I think that we share this passion of making sure that we have analytical work which is supporting what we are doing. And we had some time to try to make the case in a situation which are not the easiest, but we have kept the faith. And one of the things that I did whenever I was in my own career, moving from position to positions, were to try to see what is the economic foundation of what we are doing, and try to bring as much empirical work to support what we are doing. And one of the efforts that we started, that I started a few years ago when I was in different position, was to try to gather the economics community, academics and practitioners together to be able to think about questions that are relevant to the position that I'm working in. And the idea was to say, to find hinges who could formulate in researchable questions which are important for policymakers. So for the young that I see here, the younger researchers here, that's an important question that I will always advise you to think about. What is the researchable question? After the techniques that is behind explaining some of the puzzles that are before us, you will learn it, and you will make it more and more sharper. But the most important is to have the researchable question, the question that policymakers need to answer and to understand. So what we have been looking at is looking at emerging market and the importance of channeling resources and private capital markets to emerging markets. The question was, what are the constraints and what do we need to learn and what has been his experience? I don't know if Sergio Schmuckler is in the room, but it was among those also that we worked with on this similar type of topic when I was working in Latin America and Caribbean with Intermit. And we try to build on that effort and try to understand with a larger set of data what is happening. And I really would like to thank Susan and for really the leadership, and pushing this agenda. We are seeing this type of work not as one report, but a series of questions that we'd like to break down, because when I used to be a bit more economist, the first thing that you know that at the end of a report you have more questions that you need to address. And you just realize that the first report is just scratching the surface of the topic, and you start understanding that it's empirical work, you need to have more data to be able to understand it, that your modeling was not very good enough, and you start realizing that, and that's the things, that's the way you get progressively. So I would like you to see this as a series of reports that we'll be writing, and Cesar is with Sergio will be highlighting the next large set of questions that we would like to discuss. So on capital market, it's clear that the strategy of IFC, we would like to take information from this report and how we could mobilize long-term capital and address two challenges that we are facing, which is currency mismatch and maturity mismatch in the capital market. When you see companies, private company investing, they often have a mismatch on their balance sheet between long-term resources and investment which are long maturity, and they mobilize short-term resources. And the issue of local currency and FX risk is also one of the big constraints. As we are now discussing it in the private sector investment lab, which have been put by our President Ajay Banga in place, this is one of the two issues that also are coming very strongly from the investors. And there is a working group currently in the institution, which will look at now what are the operational side of it. How operationally we can address this, but I think that we need to continue understanding and having the foundation and understanding of the economics behind it. The second aspect is equity. To be able to leverage more private capital, you need more equity, and equity is the scarcest resource available for a lot of firms in the country we are working. So we are looking at it much more in details now, and we will, go to a way we'll be exposing our balance sheet differently as the way we have been doing it in the past, not only increasing the amount of equity, but also to take also more risk by having junior position when you take equity, try there to crowd in private equity and direct them in a country where the risk, the real risk or the perceived risk is higher than we expect. So we have started a few things. We have the World Bank Group has launched something called JCAP in 2018. It was aiming at making an assessment of the capital market in those countries and to see what are weaknesses and elements that needs to be improved. On the IFC side, we developed a training program with the Milken Foundation, where we bring practitioners in the advanced country to learn a little bit more about functioning of the capital market. But for me, this is just one part of the story. And with Patricia and other colleagues, I'm asking them to see if you can look at a little bit more critically of what has been done as a JCAP to see if there are some missing part that we haven't addressed. In that space, our colleagues of the fund are also working, but it's not necessarily as coordinated as we would like to do. So some things that Intermit and I will be certainly working on engaging with is how to bring a better alignment on all these and make sure that the capital market functioning is really addressing some of the constraints that we're seeing in emerging countries. And that's one aspect. The second one is we'll be moving more and more to securitization, but also taking into account that Basel III is affecting a lot the capital requirement of banks and financial institutions want to go in emerging countries. So we have developed instruments like the SRT, which is a synthetic risk transfer, whereby we try to leverage our balance sheet to be able to bring more of these banks in emerging market. So these are just an illustration of how the link you have between the practitioners who are trying to translate those constraints that we are having, address them in our operations, and what as the analytical work, we identified those as being constraints. I would like personally to be able to continue working on addressing, using the tools that we have. We have the Business Ready, which is an instrument. We have the CPSD, which is an instrument, which are different instruments, and the works that we'll be working, some things that we've been working actively in the meter and I and other colleagues is to try to really bring all these elements together so that we are able to really address the main constraints that we are facing in capital market development in countries, but also in investment in low-income countries. Let me finish by one sentence. When you talk about domestic resource mobilization, people often think about taxation from the government to the economy. This is one side of it, but people often don't emphasize enough the domestic resource mobilization from a capital market and savings in a lot of these countries. As you know, the saving investment balance is a big problem in all of these countries, and you need to be able to mobilize more domestic saving. So for me, I'm taking a bit of offense when people are describing countries of my part of the world as Homo Africanus, which is just more corrupt or sending money abroad, or we think. The reality is that if there were assets which were asset available, which are safe assets in which the middle class can invest, people will not take their saving outside the country. So the first and Oreo stuff that you know will be applying in our country. So the reality is that developing capital market is one of the best way of mobilizing domestic saving to address the saving investment balance that we have in our countries, but also move from a moral approach on capital flight to a much more economic analysis of the root of this capital flight. So I will stop here because you don't want to listen to me, you want to listen to the expert who will tell you what is in the report. And thank you for all of you for attending, and thank you for the expert for joining us. And once again, thank you for Intermit for his leadership and the team of DEC for all these works they're doing. I will not, I'm missing some people that I'm sorting. I see Denise, I see Paolo, but also the team of DEC, I feel Dion. Everybody has been really a part of this effort that we would like to pursue in the next couple of years. Thank you very much.
Thank you, Maktar. This is a very insightful remark. And in fact, Maktar took my punchline at the end. So, yeah, Yeah, so here, I think what I would like to do is also to thank Susan for the encouragement during this project, and also Maktar for all the guidance he has been giving us in this project, as well as Idemit in this work. So, as Maktar just said, this project is really a true one World Bank Group product. And Sergio couldn't be with us today, he's traveling, but Manuel will be doing a presentation for me on behalf of the team. Actually, the team is here, so I would like them to stand up, Alvaro and from World Bank, and Pablo Kaminsky from IFC, and Imtiaz is on paternity leave, so that's it. Yeah. So thank you very much for your hard work and also dedication. Now, you are here for financing firm growth. Why did you write this book? So basically, Maktar touched my punchline. So as we know, we have global uncertainty, we have high level of public debt. So basically, private capital is more important than ever for the growth in emerging market countries. So this leads us to a question, the main question in this book. Hello? So what is, okay, perfect. I thought you showed a PowerPoint too. Yeah, you showed a PowerPoint too. So, you didn't see it. So what is the role of capital markets in the growth of firms, jobs, and aggregate productivity in low and middle income countries? So we address this question in three ways. First, we document the large share of the large expansion of capital market of firms across countries and basically around the globe since 1990. And then we document how this large expansion is driving investment, is driving business growth, as well as employment. And then we finish by documenting the important role of policy reform in capital market growth. So how do we do this? The book uses a very novel database of issuance since 1990, and we cover 80,000 firms globally, about 147 countries, with a focus on the 20,000 firms located in 106 countries, and low and middle countries. Here you exclude China, but in the book, you present China separately. So the data we use of debt and equity issuance is coming from securities data company Platinum, and that's from LSEG, London Stock Exchange Group, which is previously was called Refinitiv. The firm balance sheet data come from Roscoe, from the same company, and our country classification comes from the World Bank from the 1990s. In terms of the measure of expansion of capital markets, we use cumulative net capital issuance, which is the sum of equity issuance and bond issuance since the beginning of the period, minus the bond of material. So what do you find? The first finding here is that capital markets for firms, capital market financing for firms has been expanding significantly. In particular, since 1990, it goes up to 4 trillion in terms of capital. And that this growth comes after 2000. So if you look at, for example, in middle-income countries, the increase is about 4 times, and for low-income countries, 8 times. So basically, from 2020 to 2022, that's the main growth that you observe. Another thing that also we have that we found very interesting is that financing through equity has been more prominent in low and middle-income countries. So this is something very interesting. And also another thing from this slide is that, not surprisingly, capital market in low-income countries is relatively smaller compared to high-income countries. But what I want you to see is that it's growing faster. So that's what we want to see here. So this expansion of capital market that we're seeing has been associated with an increasing number of new issuers in low and middle-income countries. In fact, 14,000 firms became a new participant in capital market in low and middle-income countries between 2020 and 2022. Between 20 and 2022. So now there's more firms, but also we see that it's not just located only in one country. In fact, more countries are seeing firms having access to capital markets. So if you look at over a period of 20 to 29, 25 countries basically have capital market, having firms having capital markets. And here, basically, it's all the regions. Basically, we see that across different regions. Let's now look at 2010 to 2022. We have another 20 countries that are coming. So the bottom line here from these three slides is that we see more firms from more countries having access to capital markets. Another interesting result that we have is that most of the growth of the capital market that we saw took place in domestic capital markets, which are primarily in local currency, rather than international capital markets. In fact, between 2010 and 2022, it accounts for 70% of issuance come domestically. So another interesting thing that we have also here is that this new issuer, we are counting an increasing share of the capital market financing that you observe in low-income countries. So in fact, more than 60% of the total issuance is coming from this new issuer in low and middle-income countries. But when you compare that to high-income countries, it's basically about 40%. So what are the characteristics of this new issuer, this new participant? So first, we are younger, we are smaller, and we issue smaller amount compared to the firms that were active in the 1990s. Another element that we have here, but it's not on the slide, is that these new issuers are also the most productive one. So this brings me to Manuel to continue the presentation. Manuel, floor is yours.
Okay, so thank you so much. As Cesar mentioned, Sergio Smukler couldn't make it today, so I'm going to be presenting this part of the book. So something that we learned from the previous part of the presentation is that there has been an expansion in capital markets in low and middle income countries, and that this expansion was associated with an increasing number of new issuers, new participants, firms that had not participated before, but that played a big role in accounting for this expansion. So a natural question to ask is whether this is consequential for economic outcomes, whether this phenomena that we've been documenting is consequential for economic outcomes. And the answer to this question is not obvious, because one possibility is that firms use these funds, these new funds raised in capital markets, to repay previous debt or simply to accumulate cash, in which case you should not expect a big economic effect, at least in the real economy. Another possibility, however, is that firms use these new funds for productive purposes. They hire more workers, they invest more, henceforth increasing the amount of real output they produce. So to answer this question, something that we do in the report, in the book, is to run some analysis exercise. We look at the evolution of some important variables at the firm level, like employment or physical assets, after firms issue in capital markets. And an important pattern that we document in the book is that systematically firms indeed increase the amount of workers they employ, they increase the amount of physical capital they use, and they increase the amount of sales they have in the market. Additionally, we find that these positive associations between firm dynamics and participation in capital markets is particularly strong in low-income countries. Something else that we document in the report that we think is a very important result is the fact that, again, these positive associations, how well firms do after issuing, is particularly strong for what we call new participants, for these new issuers that Cesar was talking about. And this is a very important finding because, as Cesar was telling us before, these firms are more productive. So these, and were smaller ex ante as well. So this means that capital markets help firms to expand their operations, but particularly so those firms that were ex ante smaller and more productive. So in order to have a sense of what are the overall effects of all this microevidence that we are documenting, we can aggregate all this microevidence at the level of the industry and country and just have a sense of what fraction of the amount of employment or the evolution of employment in the same period was accounted for by this evolution of capital markets. So something that we find is that around 12% and 21% of the observed change in employment and physical assets over the same period can be accounted for by this expansion in capital markets. But that's not all, because as Cesar was emphasizing before, these new participants were more productive ex ante. So the fact that these new participants were more productive ex ante, and given that exposed accounted for a significant fraction of this capital market development, generated a positive effects on aggregate productivity, accounting for around 12% of the observed evolution of productivity in these countries. In the last part of the book, we provide some empirical analysis linking the evolution of this expansion across different countries with a number of policy reforms that took place over the same period. So, for example, we document that pension reforms were followed by a significant expansion of capital markets, mostly driven by firms issuing in domestic markets, mostly coming from domestic investors. Additionally, we find that other types of policies, like those making it easier for investors to come to these countries to invest, like, for example, decreasing the amount of capital regulation or easing administrative costs of investing, actually also increased the amount of capital market activity, in this case, mostly explained by actually foreign markets. These domestic firms issuing in foreign markets, mostly relying on foreign investors. So just let me emphasize the fact that we're going to have a lot of evidence regarding, or we have a lot of evidence in the book regarding the evolution of capital markets, how it matters at the firm level, how it matters at the aggregate level once we aggregate everything. And we believe that this may help policymakers to at least to be informed about the potential benefits they may have by implementing policies in this context. And again, I would like to conclude by saying we have this new portal that is really great. So we, whoever get access to this portal is going to have access to all the facts that we document in the book and many others. So it's extremely exciting. Just you guys go out there and practice in the context of this portal. And let me just emphasize that this is hard work, hard teamwork done by all the names that you can see there, like Pablo Hernando Kaminsky, Alvaro Pedraza, and Imtia Wihak, and Sergio Smugler, who couldn't make it today. Thank you so much.
Okay, thank you very much to the authors for that excellent presentation. And now let me welcome to the stage 4 distinguished panelists. I'm going to start with Dr. Indermit Gill, who is the World Bank Group's Chief Economist and Senior Vice President for Development Economics. He has been instrumental in much of the groundbreaking research at the World Bank over the last years. Welcome, Indermit. I would also like to welcome to the stage Dr. Shebnem Kalemni-Orzan, the Schreiber Family Professor of Economics at Brown University. Her research has included work on global financial integration and capital flows. So welcome, Shebnem. We're also joined by Dr. Anusha Chari, who's professor of economics and finance at the University of North Carolina. Anusha's deep expertise in capital market liberalization and cross-border M&A flows offers an important perspective on how firms finance global markets for financing. And I'm pleased to welcome to the stage Dr. Fabio Nattalucci, who is currently the CEO of the Anderson Institute for Finance and Economics. Prior to this role, Fabio served as Deputy Director at the IMF's Monetary and Capital Markets Division, helping to shape our understanding of global financial stability. No, that's fine. Great. Let me thank all of you for joining us. As you can see, we have a diverse panel in terms of their areas of expertise. So for the first round of questions, I'm going to ask you all the same question, which is either in your reading of this report or when you look at your own professional experience over the last 20 to 25 years, we have seen capital markets develop in emerging markets, as this report documents. But what have been some of the more surprising things that you've observed or the more salient lessons that we can draw from the experience that we've had up until now. And I'm going to start with you, Fabio, and then go down the line.
So first of all, thank you for inviting me. It's a pleasure to be back on this side of the fence up there. I just jumped on the other side of the fence. So I will try to take the more private market side of this. I think one result that it's interesting in what we're describing was that the role that domestic markets play. So I'm going to try to take the international investor side. I think it's in doubt that capital markets are key driver of economic and financial development. One point that perhaps is useful to know that if you compare EM's low-income countries' share of world GDP, that number is much larger than their share of capital markets. So even if you account for the growth over the years, they've grown a lot, but they, in some sense, actually they got a smaller share, at least in some of these financial instruments. Equity market, it's widely dominated by the US, for example. And there's a number of reasons why, because to grow capital markets, you need the right macro prerequisites, you need regulatory changes, you need market liquidity, and then there are specific issues for investors like liquidity, debt, ability to trade. So the growth of the capital markets as in dollar terms is large, but as a share actually is much smaller than the economic. I think from the private sector perspective, the question is how can private sector leverage capital markets? And I think we want to highlight that when we talk about EM's investor or low-income countries investor, there's different type of investors. There are EM dedicated investors, those by mandate, they need to invest in EMs. Then there's the macro pool of capital asset manager. Those guys have a EM as a share of that portfolio. So that's one important piece. The other one, there's lots of active versus passive. So there's different type of investor that I think we need to be careful when we speak about international investor. They have different mandates, different objectives. Some of them chase an absolute level of return. Some of them chase levels. Some chase spreads. I'm going to skip maybe the advantage, the benefits for the countries that I'm sure they're going to be covered. I'm going to focus on a couple of things briefly on investor side. I think one is like what the benefits are. One is that there is less correlation of EM assets vis-a-vis developed market assets. That's an important point. And so it can be, and it's true within EMs. EMs, even the country, are not a bucket. They have different prerequisites, different policy constraints, different fundamentals, different pricing. So it's not, there's diversification within the EMs, and then there's low correlation between the EM and the advanced economies piece. The second point is that I think there are diversification benefits. The question how to think about it, now then I'll stop. I'm going to focus more on how markets think about this. When you say there is high returns, right, compared to advanced economies, I think the question you want to ask is like, what is this return? What are you being compensated for? So how much of the, for example, expected return is alpha, and how can this diversification fit into alpha? How much is if you just a bet on the EM index? And then what kind of risk premium you require? How much is the country level? How much is the project specific level? And that's where an institution like this can help to reduce some of this risk premium. Where I find myself a little uncomfortable when people say there's a lot of return available in emerging markets. Well, you need to risk adjust it. And also you need to make sure relative to what? Is high return relative to what is the counterfactual? This is mostly how investors think. So just showing high return or expected return is not enough to attract big pool of capital.
Okay, thank you. Anusha.
Thanks, Susan, and thank you for inviting me, and congratulations to the authors and the team for putting together this very thoughtful book with such amazing facts that I really found fascinating. So I'd like to begin by, in response to your question, Susan, I think that the one key development that has spurred the capital market financing of firms in emerging and developing economies has been international financial integration. And I'll just give you a couple of facts, which is that if we think about these countries in the 1980s, early 1990s, and when they were in financial autarky, that was the moment to look at what was the excess return multiple on investing in these countries. and it was 1.7 compared to the earnings price ratios in the US and the earnings multiples here. And this 1.7 excess return multiple has spawned an emerging and developing economy asset class of $15 trillion, with also speaking to Fabio's point, is over 2 trillion in assets under management, with investors who are domiciled, open-ended funds, both equity and bond, who are domiciled in just the US and Europe. So that's been a remarkable development. And I think that a key policy that spurred this was stock market liberalization. So as I mentioned, these countries were in financial autarky. They opened up, and this access to a more diverse forms of financing has led to the development of a more robust financing ecosystem in EMDEs, as this book very, very convincingly shows. So I think it's also important to recognize that the enabling environment matters. So these countries had also put in place a lot of macro reforms, inflation stabilization being absolutely key, but also trade openness, accompanied financial openness, the removal of financial repression. So ranging from macro stabilization to micro corporate governance issues, I think that there was a lot of policy reforms that took place that enhanced this enabling environment that allowed for this ecosystem to develop. We can talk about this a little bit more, but what this has facilitated is that we have more than just bank finance being the only game in town. And when, and Mukhtar talked about, the importance of equity, the role of equity, which is really risk sharing and embodies true risk sharing compared to debt financing, which is, there's been this over-reliance on debt, which is a non-state contingent contract. And I think promoting equity financing with this risk sharing has also been key. I found the book's findings on the pension reforms and the pre-funded pension systems to unlock capital extremely interesting. And I think that speaks to this issue of measures to diversify the investor base by trying to develop a domestic investor base and expanding the menu and the choices that domestic investors have to invest in equity and bond markets locally. And I'll end by saying that I think that another really interesting development has been the development of local bond markets and moving away from a lot of the debates that we had before on original sin. And Mukhtar talked about currency mismatches, and I think local bond market development has really been important in not only developing a yield curve off of which privates can price their bond yields, but I think that has also been really, really important. So let me just stop there.
Thank you. Shebnem.
Thank you so much, Susan, for inviting me to this extremely distinguished panel. It's a pleasure to be here. And I also want to start, as Anusha and Fabio did, by congratulating the authors. This is an extremely well done, very insightful and very timely book. And actually, I am also writing a book called Financing Firm Growth for University of Chicago Press. Now, reading this book, I have to change my title, clearly. I have to find another title. So, yeah, exactly. So you beat me to it. Obviously, given the extremely productive authors of this study. I mean, I like everything in this book. Again, I said it's, I think, very timely, a topic that is dear to my heart. I think it should be the key topic in institutions like, World Bank and IFC. So, there's really, when I, first read the whole thing, I mean, what is not to like, right? I mean, so I think it's very, very good, very well done, very important. I really like this whole, comparison between, low and middle income countries kind of emerging markets, like, debt versus equity financing. These are all, forefront issues here within the broad issue of financing firm growth. Maybe I will just add a few points taking from where Anusha left. Also, maybe this will help us also to think is like kind of now what are the next steps in the future. I think the big issue here is really understanding and acknowledging this huge increase in equity financing, private capital coming through equity, coming through portfolio. That's a great development. I fully agree with Anusha on that. But I think once we kind of acknowledgement this amazing development, which is part of the international financial integration of these countries, and kind of look at these trends and then start looking in terms of shares, we still see actually that, it is still the bank financing is the game in town, unfortunately. Again, this shouldn't be like that, but this is the fact. I mean, when you look at the entire financing and how much, banks are in it, both domestic banks and the foreign banks, how much capital flow coming into emerging markets and developing countries, and what is the shares? The share is still going to be, the lion's share is still going to go to the banks, and after that, the governments. I mean, governments are still big borrowers, in these countries. So unfortunately, when we want to push everything towards equity, the non-contingent state contract debt is still being the main lion's share form of financing. So how to get out of that? Now, this, and then put the government aside for a minute, focus on the private capital flow. So IMF has this recent study. In fact, I was in one of the panels during the last year's spring meetings with Geeta Gopinath and others, titled "Where Capital Flows is Going, What Type of Capital Flows, Where the Money is Going." And they did a study for that, and the entire private capital we are talking about, entire private capital from foreigners coming into these countries is 1 trillion. 1 trillion, not more than that. So the bigger numbers we see, from Anusha's research and other research, of course, is going to have the, valuation effects. These are hedge funds, open-end funds like portfolio and all that. But if we just do on the constant prices, the entire foreigners, what the foreigners are bringing into the entire group, except China. Take the China out for a minute, because we really want to understand what is the story of, low and middle income countries. Take the China out. And in fact, China is not a low income country anymore. It is 1 trillion. It's just that's that. This is the private. It's just 1 trillion. And if you look at how much these countries, low and middle income countries and emerging markets need for green transition, it is 1 trillion. So if they are going to do it through foreigners only, they have to double what they are getting, which is not going to happen. I mean, we all realize that, right? I mean, that's not, they are getting 1 trillion just only for green transition, only for green transition, they need to double that amount. Again, assuming this is all done through foreigners. So this goes back to exactly what Anusha is saying. Domestic markets are super important here. Domestic markets are super important. We have to understand domestic investors. Banks have a super important role in that domestic market, in not just low income and middle income countries, even kind of the more richer emerging markets. So we have to understand how to navigate this space, how we are going to bring domestic investors to the scene, how we tilt it more to equity, how we are going to really find the small and productive guys. Misallocation of capital is also a big part of here. I mean, if the domestic guys cannot allocate properly, how are we going to make sure the foreign guys are going to come and invest to the right guy? I mean, if the domestic guys are not doing the right thing here. So in that sense, I think that's something we really need to focus on. And this is also going back to, Fabio's question. I mean, like, what is this, productivity and return relative to what? We all understand the risk. We all understand that it has to be risk adjusted, but relative to what? I mean, we also know the big money still comes to US stock markets. I mean, this is another fact. I mean, the most productive firms are the US companies. The deepest, most liquid equity markets are in the United States. And this is where they invest. I mean, this is relative to your what? This is the answer to that, because those are the firms all the foreigners want to invest. So we have to somehow come to terms with that, and then really push the development of all sorts of domestic financial markets, not make the banks only game in town, and really help domestic investors together with foreign investors to invest really these small and productive guys, because that's going to be the next big dividend that we are going to, if we help fix, we are going to see growth in these low and middle income countries.
Thank you, Shabnam. And Indermit, please come in.
Yeah, I should have spoken before Shabnam because I think that she hit all the good points. So two or three things. I think the first one is how important is this report right now? I think this is a very important juncture at which we should be talking about issues like this for several reasons, right? One is I was looking at the measures of global policy uncertainty, which is a very important determinant of private investment. And that is 3 times as high today than it was 2 decades ago, massively higher. And it was already high before all of the Trump tariffs and things like that. So it's not just something that happened last week or last month, okay? The second thing is if you look at FDI flows, our work indicates that this has fallen from about 5% of GDP of the income, 5% of the GDP of developing economies and emerging markets. That was about 15 years ago, and now it's actually less than half that. So it's around 2%, right? And I think that the point that Shabnam is making is absolutely right. If you look at these flows and you see how much of that is actually going to banks in these countries, that is a big chunk of it. And then if you look at what the banks are doing with that money, I think the banks are basically channeling a large chunk of that to governments in these countries, because at the same time that all these things are happening, domestic public debt has gone up massively, right? So then you actually look at the results of the report and you sort of say, okay, what is it that the report finds? I think that if you sort of put it in the backdrop of all of this stuff, it makes sense what the report finds, in the sense that it's that firms have been tapping private equity markets, and the amounts are not that big. They are having a harder time tapping private bond markets because governments are competing and winning usually, right? So I think that the report has done a very good job of answering what has happened, and then actually it's also done a pretty good job of answering what have been the effects of this on the firms themselves. So, for example, it finds that when it comes to increases in investment, good. When it comes to increases in employment, not that bad. When it comes to increases in productivity, not that great. Okay. So has this money led to an improved efficiency of the private sector in intermediating capital? Not that clear how much that has happened, right? So then the part that I think that we need to sort of discuss more, and we didn't plan to do it in the report, but we should actually plan to do it now. And this is the question that Makhtar raised, in the sense that what are the questions that this report raises? The questions I think that it raises is, what is it that led to these changes? Okay, has this happened because of governments or in spite of them? Okay, and I think that the answer is, a little bit of both, right? And then you have to sort of look at the role of governments as regulators, as exacerbators of country debt risk, exacerbators of country risk generally, right? And then also as competitors of debt financing within these countries. The whole issue of crowding out, right? Now, if you look at all of this stuff and you sort of see what is happening to private investment ratios, they have been declining in a lot of countries, including some of the countries that are quote unquote doing very well, like India and so on. So the final question, of course, then is, what is it that the World Bank and the IFC, what is it that they have been doing? And I hope that Shabnam answers those questions in her report, and answers them in very, very blunt terms, and especially on the things that we have been doing wrong.
Thank you. I'm going to come back to you, Indermit, and ask you what the World Bank group should be doing. But okay, for the second round of questions, you've all brought up in various ways some of the shortcomings. The report celebrates what's happened, but we've heard that capital markets as a share of global has not kept pace with the growth of emerging markets. We've heard that the absolute stock of foreign investment in emerging markets is only $1 trillion, which is actually astonishingly little when we talk about the trillions needed for the SDGs or climate or this or that. So now I want to go and talk about both the risks and the barriers. So I remember back in the 1990s, actually at the World Bank Group, Ross Levine and others, started to say, and especially after the 1997 Asian financial crisis, we need to develop local capital markets. So we've been talking about this now for a very long time, and there has been some progress, but clearly not enough. I also remember the days when we didn't want trillions of dollars flowing into emerging markets because it was potentially risky and volatile and hot money that could be withdrawn and sink your currency. So in this round, I'll give you all the choice of whether you want to talk about some of the risks that we need to be aware of in developing capital markets or opening up to tapping into foreign or international capital markets, or how to do it right. We can spin this because we are an institution of action. What can we do in the face of what's happened very practically to tap into further growth, to allow more firms to access capital, and to Indermit's point, to make sure that you get an even bigger boost in terms of productivity and growth from it. So once again, I'll go down the line.
So I'll stay out of the policy recommendation and leave the policy recommendation to the rest of the panelists maybe, but maybe three buckets of comments. I think one is, I think we need to distinguish structural issues, barriers versus conjunctural barriers. We sort of got used to the post-GFC pre-COVID world where interest rates were very low. In advanced economies, you get negative rates in a bunch of European countries, very low in the US as well. So EMs was a natural source of additional yield, particularly if you were a nominal yield target investor. You had some number that you had to hit at the end of the year, institutional investors. That backdrop has completely changed. You can make 4+ just buying US 10-year treasury yields in terms of returns. So that is, anyone you talk to in the private sector is very negative for EMs. Why would I take that kind of risk when I can make 4 or 5% in advanced economies? The second one is we came out of COVID with very high level of public debt. So a lot of these countries have a huge amount of financing they need to do that will affect the cost of capital for the private sector. And then the third, I think, headwinds against EMs is the uncertainty. The last global financial stability report I worked on before leaving the fund was about the impact of uncertainty on macroeconomic outcomes. And we clear that GFSR chapter clearly finds that there is a negative impact of increase, however you measure uncertainty, trade, policies, what kind of index you want to use, on the distribution of GDP, particularly on the downside tail. So higher uncertainty hits the distribution shape, particularly the tail. And that hit, it's more elevated if you are in a world where volatility in markets is low. Take the VIX, takes any measure, it's still very low given how much uncertainty is, and if vulnerabilities are high, so stretch valuation. So in that world, that's another conjunctural issue that is going to hit EMs more than advanced economies. So that's one point. The second point is like, what are the risks to countries? Maybe I can be brief here. Is the usual argument of capital flows, sudden stops, interconnectedness of the global financial system, particularly because when more private capital comes into this country, usually associated with higher leverage. And we know how the deleveraging cycle works. And the last point more, it's on the, I think on the private sector side, I think there's three kind of barriers that you can think of. One has to do with the macro policies, whether we have the right macro, I don't know, central banking independence, the macro policy in place, the legal institution and so on. The second one has to do more on the regulatory basis, whether we have regulatory market structure, investor protection, disclosure, and so on. But then there is a third one that I think it's often not appreciated enough from the private sector perspective, which is, because it's very hard to price, which is the unlocking large amount of capital, private capital. You need market size, you need liquidity, you need breadth of these markets, you need informational availability, that's where it's very hard to price. And that's where, if you want to bring private capital from outside, it's very hard to do. They need to be, particularly the large global asset managers, they need to be able to go in and out. If you're not able to liquidate at times of stress, they're not going to take large positions. The regulatory environment is very important, the clarity of regulatory environment. Market liquidity in general at times of stress disappears, and so the larger your position, the more exposed you are. And again, in a world where rates are higher in the advanced economies, why would I go there? And then there's the diversification issue. So if you are an EM dedicated investor, then you need to invest in EMs by mandate. But if you are a global investor where EMs, it's some small share of your assets, whether you take it through beta to an index, or whether you take it through alpha and you go what the book is saying to do to more at the firm level, in this environment of high uncertainty, the remuneration is much higher, everything else equal. So it's very hard to attract capital to do that right now. And then there's the FX risk, which we already discussed.
Great, thank you. Anusha.
Yeah, so just building on your points, I think that I talked about the benefits of capital market integration, but then there are the downsides of capital market integration that these economies are a lot more exposed to risk-off shocks. And there can be, a variety of these shocks. It can be US monetary policy, as we saw with the taper episode. It can be, shocks to market liquidity, funding liquidity, spreads in markets that are based here that lead to a rebalancing out of these markets. But what we see is that enabling environment does matter. So, countries with strong fundamentals, macro fundamentals, regulatory certainty, and a robust regulatory environment are more shielded from these shocks. So I think that continues to be incredibly important. And picking up on what you were saying, I think that in order to encourage this foreign participation in equity markets, it's really important to focus on those corporate governance issues of transparency in corporate reporting, disclosure standards, protection for minority investors, et cetera. And I'd like to add a couple of more points. We've talked about fiscal risks and fiscal dominance and how that can impact the access of private firms in these markets to access capital. But I'd also like to talk a little bit about related to what Shabnam was saying about state-owned, that we have a lot of bank finance in these markets. And in a number of countries, this tends to be state-owned banks who tend to have soft budget constraints that have recourse to the government's balance sheet and often access, there's sort of financial repression in terms of them being able to access loans at subsidized interest rates. And this is quite pernicious because what we see in the data is that it can have spillover effects to lending in general in these economies. So healthy firms tend to be crowded out when we have what is known as zombie lending. And you see that for banks who have a lot of zombies in their lending portfolio, but also in industries where you have a lot of these zombie firms that are surviving on evergreen loans that are limping along on this life support, that tends to crowd out healthy firms in industries as well. So it has, in terms of macroeconomic impact, the role of state-owned banks and these distortions that are created by state-owned banks is something that we see in a number of economies. And that is something that I think of as a challenge. And finally, I think what the book shows is a lot of new issuance by small firms, which is very welcome. But in my research, we've also seen when we look at these firm size distribution, we have this missing middle in the firm size distribution. So you tend to have, like in a country like India, you have a small number of large firms and a large number of small firms. And what would be really interesting to see is do these small firms actually start growing to occupy that missing middle? So let me stop there.
Thank you. Shabnam.
Thank you. So I think the biggest issue here is really the risk and how we can get around that risk issue while we, fix the domestic market. So domestic investors and domestic financial markets development that's number one, right? I mean, but that is also sensitive to risk, right? I mean, we know during these risk-off events and financial shocks, domestics are most of the time the first one to leave, right? So in that sense, the whole domestic should be done. The foreigners should be attracted. Obviously, we want to attract foreigners. This is all, I'm talking about private. So no government, no state-owned banks. I mean, this is also true for private banks, right? We want private foreign banks still to come too. And all that issue really resolves around risk. And this, on this, I want to go to what Intermit said, right? I mean, the key question here is how do we do this in spite of the government, right? How do we do this in spite of the governments? Because, I mean, there are going to be aggregate shocks always, right? So if your risk of shock comes from US monetary policy or some global financial crisis or some pandemic, that's aggregate. There's nothing you can do to that. I mean, there's no such thing as a diversified portfolio to fix that, right? Because that whole diversification risk sharing idea is about idiosyncratic shock. So for the aggregate stuff, we cannot do anything. But why on earth we create idiosyncratic risk shocks? I mean, why we do this? And if you look at this, when I say we, this we is most of the time in these countries, in emerging markets, low and middle income countries, are the governments and some sort of policy mistakes. Either and this is very broad. So you can think this anything from default risk to bad monetary policy, bad fiscal policy. I mean bad regulatory policy. I mean this is just like the whole spectrum. So in that sense, I kind of put all of these things, regulation, macro house being in order, good fund, all of that I put under strong institutions umbrella, right? I mean, because good policy making, whatever policy that is, and strong institutions, that goes together. These two feed to each other. And I think a lot of this risk, which I call local risk, the local risk factor, that really scares off your domestic investor and the foreign investor, regardless of who that investor is. It can be a bank or it can be a portfolio guy, as long as this is a private, we are talking about private investing. Why you do that? I think so somehow I think this is, and I'm trying to figure this out during the last 20 years of my research, but it is very, very difficult. And I think institutions like World Bank, IFC, they have very, very important roles here, because to do this in spite of the government, around the government, it's a very, very difficult thing to do. And that's, I think, the biggest challenge. But somehow if we solve that, and again, I think this is a collective thing. I mean, neither the academics alone nor the institutions alone are going to solve this. But together, I think if we figure out the solution to this, I think that's going to be really the next decade of growth for these countries.
Thank you. And Intermit, please.
So I'll just expand on the point that Shabnam just made, which is that when, so I could take sort of three regions, Susan. I could take Africa, and then when we look at Africa, like essentially a few years ago, I looked at the CPIA scores for Africa and saw where is it that Africa has improved its institutions and policies. The sector that stands out, Shabnam, is actually the financial sector. That's pretty much the only place where actually these countries did better over the last 15 years or so. The problem is that that space was entirely taken by governments in the sense that they actually just borrowed. So if you also sort of look at the countries and look at their shares of debt to GDP, that went up, and a large part of it was a shift from foreign debt to domestic debt. Now, if you look at our the way that we actually measure the effect of this on the prospects of these countries in terms of stability and growth, the fund and the bank do a crappy job of it, okay? In the sense that we actually didn't update our debt sustainability assessment instruments to include domestic debt at all. I mean, we kind of added it as an afterthought. The second thing is that if you look at pension reforms, I saw that the report actually mentions LAC pensions reforms. So I worked in Latin America and I worked in ECA, okay? And basically we attributed a lot. We hung a lot of hope on pension reforms because we thought this would lead to greater capital markets and so on. Same story as Africa. Basically what happened was that you did get an improvement in capital markets, but the government filled the place because in Chile, things were different because they did a fiscal reform at the same time that they did the pension reform. But if you didn't do that, and most of the other countries didn't, then that space was again filled by filled by governments. I mean, Argentina is just an extreme case of this, but that's true across the board, Mexico, et cetera, as well as in ECA. So, and the best way to sort of see what was the net effect of all of that stuff is take a look at potential growth rates in LAC and ECA, okay? They're terrible, they're low, and they haven't increased. So if this capital market development was going to do wonderful things, we should have then actually seen that potential growth rates in these countries would go up. They didn't. Okay? I think where we could actually get a lot more, I think we could get a lot more insights, I think perhaps, is to look at business readiness. And here Norman's team is actually working on the Be Ready report and so on, and see whether or not the investment climate could be improved more. And then as a result of it, it could well be that the rates of return to private investment go up and these firms start to outcompete governments. Because if you can't outcompete governments now that they are on the brink of debt default or debt distress and so on, you could never do it, right? And I think the one part that I found was we always sort of put China as a lump and we say, oh, you know, we're going to take China out of this. And of course, China is the biggest part of the story, 80% of these numbers. But so I just came back from China. And basically what you find is China is very, very different if you look at a province like Zhejiang, which is where, which is essentially where DeepSeek and Alibaba and all are. And if you look at their business environment, if you look at their availability of private finance for business and so on, it's fantastic, okay? But then there are other parts of China where you go, and then they're way less than fantastic in the sense that, so, you know, I think one of the things that if we can somehow actually earn the trust of the Chinese government to actually help them look at the big differences within China, right? So I think that is one thing that you should know, that we are fielding these enterprise surveys now for 60 countries every year as part of the doing business to business ready revamp and so on. So we will actually have all of that available, Shabnam and Anusha and others. We'll actually have all of those data available, and we are moving from enterprise surveys or just essentially expert surveys in two cities in countries like China, like it would be Beijing and Shanghai, to nationally representative enterprise surveys. And the Chinese government is behind this. I think we could do the same thing in the case of India and all as well. If you sort of look at India and China, you might actually get much, much more insights in terms of how to increase the finance for private firms, right? So I think we're on the cusp of a very, very important initiative. Yeah.
Great, thank you very much. We have unfortunately run out of time. This has been incredibly interesting, and I could sit here for another hour or two and follow up on this, particularly on the point on China, which I've heard of. If you look across Chinese provinces, China is really a collection of high-income, middle-income, and low-income countries all within its borders. So there's a lot to learn. But thank you all very much for joining what we hope will be the first of a whole series of future conversations around these topics of capital market development, foreign versus domestic, institutional development, the cost of capital, what investors are looking for. So thank you very much for sharing your time with us today. Yeah, exactly. you.